So, you have heard of exchange traded funds, short for ETFs, maybe from blogs, from videos, or just someone you know recommended you to it. Whichever that is, you have heard it right, because ETFs can indeed help you to build a diversified portfolio, minimize your risk taken, plus it's the ultimate form of passive investing that you barely need to do any homework. Plus, it's the cheapest form of fund investment out there. Now, say goodbye to all the unit trusts and all the mutual funds. So here I am to complete the last mile of your research journey, because in this video, I'll talk about the 5 most popular ETF categories that are usually the go-to choices for most first-time investors as well as for seasoned investors. Let's start with the classic, the S&P 500 index. It is like the classic and old reliable car that is not going to win races, but historically, it's very dependable. It gets you where you need to go and it won't break down in the middle of the highway. And for most first-time investors, this reliability and also the peace of mind that it brings you could literally be the most important factor to build up your confidence and also your risk appetite in investing, which will also then encourage you to invest more money down the road. In fact, if I'm only allowed to pick one index only, this will be it. This index tracks the top 500 companies in the US, and it is widely known as a benchmark of the US economy itself. So to invest in this one ETF alone, you are basically investing your money into the best companies in the US or even worldwide. There are a lot of ETFs tracking this index, but the 4 main ones that I would gladly recommend to any first-timers would be the VOO, SPLG, IVV and SPY ETF that you can type to get them on any online broker. And before you ask, they all do the same thing, just that it's provided by different fund managers or agents. So maybe there might be a little bit of discrepancies in terms of expense ratios, assets under management, tracking accuracy, etc. And as you can see here, they are basically more than 99.9% the same thing. Same top 5 holdings of Apple, Microsoft, Amazon, Nvidia and Alphabet, which is Google's parent company, and their returns are also very similar. 3-year return of around 8.4%, 5-year return of around 10.9%, and the 10-year return lies around 11.2%, which is very solid if you think about it, on top of the benefit of investing in a US dollar denominated asset, which historically appreciates against most of our home currencies, like Malaysian ringgit. So that's essentially hitting 2 birds with 1 stone. If you invested $10,000 10 years ago, every year your asset increased by about 11.2%. Now you'll be holding around $29,000 with hardly any effort from your end at all. So back to the comparison, the main difference here comes down to how established the fund is and also the fees, or we call it the expense ratio. VOO and also SPY ETFs are 2 of the biggest funds out of these 4 ETFs, and the expense ratio varies from SPLG being the cheapest at 0.02% to SPY being the most pricey at 0.09% per annum. So how would this affect you? Say your return this year is 5%, so with the same $10,000 investment, SPLG will give you a return of $497, while SPY will give back around $491 after fees. And it might not sound a lot in this example, just $6, right? But imagine if you keep adding money into this investment and let it compound over the long run, that will slowly snowball into hundreds, if not thousands of dollars down the road. So if you ask me, I will go for VOO ETF since it has a rather low expense ratio, huge assets under management, plus the fund manager Vanguard is very well established with a very long track record. And just a quick pause here, all the ETFs mentioned in this video are very popular, and you can easily find them on most brokers that offer US market investing. My personal preference is Interactive Brokers because of their low fees plus fractional shares trading feature. So feel free to use my link down below to open an account and start investing within a day or 2. Now next, we have one of the highest growth ETF over the long run, the nasdaq 100 index ETFs. If you've never heard of it, nasdaq 100 consists of 100 of the largest and most actively traded non-financial companies listed on the US Nasdaq Stock Exchange. And the unique point about this index is that they have a high weightage on US technology stocks that have historically experienced higher growth rate and return. But it does also come with equally higher volatility, so do take note on that. So it's not hard to imagine that their top 5 holdings are again Apple, Microsoft, Amazon, Nvidia and Meta, which is Facebook and Instagram, which sounds about the same to the S&P 500 just now. But if you look just further, nasdaq 100 does not include financial companies like JP Morgan, Bank of America, MasterCard, Visa, etc. So the most famous ETF tracking this index is QQQ by Invesco, and one reason for its popularity is its high return. I mean, just look at their 5 and 10 years return, a staggering 16+% per annum. Who doesn't love it? But instead of QQQ, I will introduce you to its little brother, the QQQM ETF. They are basically almost the same thing, but the younger and newer QQQM is significantly smaller in assets under management, and so they come with a lower expense ratio of 0.15% per annum in order to compete with its elder and also a more popular brother QQQ. What's their drawback? Well, a smaller assets under management usually means lower liquidity, aka trading volume, and that will mean you might be paying a slightly higher spread when trading them, either buying or selling. But this usually affects active traders rather more, so if you are just investing in it for just the long term, that minor trading spread difference should not matter to you at all. So since they are technically the same thing, I would personally pick QQQM for the purpose of long-term investing, since it comes at a much cheaper package. Now, some of you might think that tech stocks are a bit too risky and you want some safer options. No worries, I got you fam. VIG and SCHD ETFs are 2 of the dividend ETFs that you might be looking for. Instead of high growth that associates with high uncertainty, VIG focuses on companies that increase their dividend for 10 years straight or even more, while the other hand, SCHD tracks the Dow Jones US Dividend 100 Index. And theoretically, companies that can afford to pay dividends to its shareholders periodically are those big, profitable and also mature companies. So in a way, they are more financially stable. And while this may not always be true 100% of the time, a lot of time dividend stocks prices do not fluctuate as much as growth stocks. So investing in these might just give you some peace of mind. The top holdings of VIG are Microsoft, Apple, ExxonMobil, United Health and JP Morgan Chase Bank. Just some classic combinations. While the top holdings of SCHD are less well known. Amgen, which is a biotech firm, AbbVie, which is a pharmaceutical company, Chevron, a energy company, Broadcom, semiconductor software and more, and also Merck & Co, also a pharmaceutical company. And by the way, just some grandmother advice, the increment of dividend yield or payout does not necessarily mean a good thing at all, and you should be aware of 2 situations. 1. If a company increases its dividend payout without an increase in their earnings to support the decision, you can guess it already. This payout can be unsustainable in the long run, and the ever-increasing dividend can be an illusion that the company creates to let people like me and you to think that they are earning good bucks. In fact, maybe they are not. Second condition, be aware that the dividend payout does not eat into the chunk of money that the company should use to reinvest into their businesses. If most of the money is paid out and there's not enough money to support innovations and future growth within them, it's only a matter of time that they will be surpassed by their competitors. So back to the ETFs, all funds here have their own strategy, so it's better to let the performance speak for itself. For the 3 years return, SCHD outperformed VIG, giving a 9% per annum return, compared to only 6 to 7% returns by VIG. However, in the long run, VIG and SCHD does give similar high returns of 10% or more per annum. And expense ratio wise, both VIG and SCHD would cost about 0.06% per annum. And since they mainly hold dividend paying stocks, VIG gives a dividend yield of 1.95%, while SCHD gives about 3.9% per annum. So if you ask me, either of them would be fine, but if I must choose, yes, VIG has a longer track record and the assets under management AUM is 30% more than SCHD, But the point of being dividend ETFs is to have higher dividend yield, so SCHD would be my choice over here. And of course, just a quick note here, since they are all US based ETFs here, whatever dividend yield that you see here is before the 30% dividend withholding tax. And for most of us coming from a country without the tax treaty with the US, we're gonna have to take that into consideration as well. But then again, 10% return and 3+% yield for every year seems like a pretty good deal to me. Now, all the ETFs that we have talked about just now are all about the conglomerates and huge US companies. But if you don't want to miss out on the high growth potential from the smaller cap companies, then you can also consider further diversifying your investment through this particular category of US total stock market, and it comes under the ticker symbol VTI. This ETF alone will help you diversify your money to all small, medium and large cap companies in the US. So technically, your portfolio is relatively less dependent on the big companies, and you are basically investing on the average of the entire US economy as a whole, which if you take a closer look, its return is actually on par with the S&P 500 index. 7% per annum for the last 3 years, or around 10% per annum in the last 5 to 10 years. And even though this ETF does diversify to all large, medium and small cap stocks, their top 5 holdings are still the same: Apple, Microsoft, Amazon, Nvidia and also Alphabet. Sounds familiar? Yes, it's still the same as the S&P 500 Index ETF, but of course, their weightage or influence in this ETF will be much lesser compared to the S&P 500s. But what's great here is their expense ratio is also super low at only 0.03% per annum, which is almost as low as you can get in the world of fund management, just like VOO and also SPLG. So you can think of it as the more diversified version of the S&P 500 ETFs, and you can hardly go wrong with it since you are technically betting on the US economy as a whole. Unless it fails due to war or some unforeseen reasons, then that's a different story lah. So now you know you can invest in almost the whole US economy by buying the VTI ETF. What if a whole country sounds not enough for you? Perhaps you'd like to invest in the entire world stock market. Is that even possible? Yes, here comes the ACWI and VT ETF. The ACWI tracks the large and mid-cap stocks in both emerging and also developed stock markets. And on the other hand, VT ETF tracks the global stocks according to its weightage of market cap. But why bother to invest around the world? There's one thing that we call geopolitical diversification, and as simple as it sounds, it's to spread your risk in different countries so that you are also able to capture the potential growth from emerging markets that might have different growth prospects when compared to developed countries like the US and also the Europe. And you also get the additional benefit of diversifying your currency risk to not just be limited to the US dollar only, if that's what you're into. Anyways, ACWI ETF has about 60% holdings in the US, while the rest are in Japan, UK, Hong Kong, France, Canada, Switzerland, etc. etc. Meanwhile, the VT ETF has their holdings in, well, almost the same countries, just that the weightage is different. So it comes with zero surprises that their returns look vastly similar, around 5% per annum for the past 3 years and more than 7% of 5 and 10 years annualized returns. Yes, all in all, they does seem a little bit lackluster as compared to just investing in the US market alone. And that's also because the US market has practically outperformed every other countries in the past decades. But let's not forget, the goal here is diversification. You are effectively taking lower risk, hence the lower return. And between two of them, one huge difference is the expense ratio. While ACWI asks around 0.32%, VT lowers them to just 0.07%. So by all means, you know who's the winner over here. So here we go, I've summarized all my picks for each of these 5 categories for you over here, so feel free to pause this video and screenshot this frame. Now here's my verdict. For all intended purposes, you can hardly go wrong with the S&P 500 ETFs. It has proven itself time and time again, and historically, professional fund managers find it hard to even beat its track record. Well, of course, unless the US government fails, which then again, what are the odds of that happening?
In my view, for most people, the best thing to do is to own the S&P 500.
But if you prefer a consistent stream of dividends coming into your account, usually quarterly, and you don't mind paying the higher US withholding tax, or you generally prefer mature companies that have probably peaked their business models and can pay dividends periodically, go for the dividend ETFs instead. But if you are the YOLO type and you don't like to balance risk and reward, and you want to be more aggressive with the returns, and you like tech companies in general, then the nasdaq 100 index is definitely the top choice for you over here. But if you want to take it one step further and you like total diversification because you value stability more than anything else, then the US total stock market or the entire world stock market might just be what you are looking for. Alright, that kinda summarizes the entire point of this video. There are ETFs that can't really go wrong for first time investors and are generally good / safe picks whether you are just starting out or just looking for different options to build up your investment portfolio. And obviously, there's no best ETF out there that is one size fits all. You should ideally choose your investment vehicle or ETF in this context depending on the kind of risk and return you are looking for. But just in case you still can't make up your mind, you can remember this thumb rule. You can never go wrong going for the big funds with low expense ratio, regardless of the ETFs. Because hey, who says you can't sell it off and invest in another ETF down the road? It's your money, right? The usual disclaimer applies. These suggestions are purely based on my research and my personal preferences only. You need to invest based on your risk appetite as well as your intended goal. So if you'd like to know more about the S&P 500 ETFs, my favorite, I have the video here just for you. See you over there.